Look at now some different policies, how they affect your business. Depreciation policy. So as we said, depreciation policy can cover few aspects, means the life, the minimum criteria to recognize as an asset. So you can have some fixed amount. For example, like in hotels, we have a policy that normally a spoon you can use for more than 5 years, right? If it's a stainless steel spoon. So, but every spoon we are not going to recognize as an asset because it does cost very less amount. So we have a policy that okay, if anything is cost unit price is cost less than $100, we will not touch it as an asset. We'll just charge it to the expense because we don't want to stuck in into the spoons, forks, or the ladders. We don't want to recognize that. We just record that as operating expense. But we keep inventory physically of all the items that we buy. Even a spoon, even a fork, we have record of every single thing. Whatever is coming out of the hotel or whatever is coming in the hotel. But we don't recognize as an asset. We immediately charge to the expense. But it depends on the size of the hotel. When I used to work for Shangri-La, the size of the hotel is very big. So we can afford $100. When I'm working here in Myanmar, the size of the hotel is very small. So I made a policy of $50 because otherwise everything will go charge as a expense. Nothing will be remaining the asset, right? Then you have estimated life of use. So it depends on how you use your asset and in which location you are situated at. The same value, same asset will have a different life in different conditions. For example, a water filter. If you are in Yangon, the water is very heavy, so filter will run out very fast. But if you are in a city where the water is clean, then the water filter will not damage so fast, right? So it depends on where you are and what are the intended use of asset. So the companies normally determine what are the life of their assets. Some companies, because they don't want to have a separate set of accounts, they follow government rates. Whatever is government prescribed, we will use. We don't want to have a different accounting policy. Like my current company, we follow government rules. We don't have our own accounting depreciation rates because otherwise we have to have one for our set and one set for government. So which is not ideal to maintain, right? So we follow one. Then you have method of charging depreciation. So how you charge the depreciation? You have different methods of charging depreciation. One is straight line. Whatever you buy, you just divide by 5 and charge equal. Another method is, if let's say you say the initial year my business is very low, or let's say you buy a machine which can produce let's say 10,000 units, and you know in the initial year I'm not going to use my production will not be very high because I just started up the business. Maybe I will use 1,000. Correct. Second year I may produce 3,000. Fourth year I may produce 2,000. Fifth year I may produce the balance. So you are charging based on your estimated production. So based on production capacity. Okay. And then another method is called written down value method. Did I explain? Yeah. So written down value method means we will charge you based on a fixed percentage. Let's say we charge 20% depreciation every year, but on the balance. So if the start asset with the asset starts with 1,000, so first year depreciation will be 20. Correct. What is the balance left? 100 minus 20 is 80. So the next year I will charge 20% of 80. So the next year depreciation will be 16. Right? What is the balance? 18 minus 16 becomes whatever. And then 20% of that left over. So that is called written down value. So we are charging depreciation a fixed percentage. Here the depreciation is not fixed. In straight line method, every year depreciation is the same. In written down value, depreciation is not the same. It is the highest in the beginning and lowest at the end of the year. Correct? It follows the certain rule that okay, when the asset is new, is used most. When the asset get older, the efficiency of asset get reduced, right? You use less. The value is less, so you charge less. or based on usage if the life is fixed. Let's say a car engine can be run for 100,000 kilometers. So it depends on how you intend to use it. If you intend to use every year same amount, then you charge exactly the same. If you have a different schedule, you can use different schedule, right? Depend on accounting policy of the company. So you can have a different set of policies, but you don't change it every year. Once you set, you have to follow it, and you have to follow for all the assets. You cannot say my building will be written down value and my laptop will be straight line. You cannot do that. You have to follow the same method for every asset that you have in the company. Okay, this is an example. So let's say there is a machine that makes shoes. Okay, so assuming the cost is $100,000 and the life is $10. Residual value is 10,000. What is residual value? Sorry, the spelling is wrong. But residual value, what is the meaning of residual value?
Depreciation.
No, means at the end of 10 years, what will be the value of this machine?
10,000.
Hmm?
That value.
Yes. And what is the residual value? How much the value of life? How much will the value of machine after 10 years? So that is called residual value. So the production schedule is like this: 2,000, 3,000, 4,000. I just made it up. So now if we calculate the depreciation, so this is the depreciation as per how we calculate. Cost is 100,000 minus the residual value. You don't charge depreciation on residual value. And the most companies, they made mistakes on residual value. All the international accounting standards, they require us, the companies, to identify residual value for all assets. And the depreciation is charged only on the balance amount. So total value of construction minus residual value, the balance is 90,000. So you can charge depreciation on 90,000, not on 100,000. Okay, where the most of the companies they make mistakes is they don't recognize 10,000. They charge depreciation on whole 100,000 because it's very difficult to know what will be the value of machine after 10 years. But there will be certain value, right? Even though the laptop after 10 years is gonna go waste, you still can get maybe $10, maybe $20, or if you break down, the screen can get something, the hard disk can get something, right? So there is a value. It's not that there is zero value. There will be some value. So companies normally have to identify a value which they can get after the life of the asset, and then they reduce it. So the balance amount is 90,000. So as per straight line, you charge 9,000 each year. If you follow the usage is total is 30, usage is 2,000, 3,000, 4,000, total is 36. So what you do is 90,000 divided by 36,500. For every single unit, how much is the value of asset? Then you multiply with the unit of asset every year. So here you are charging the depreciation as per the usage. Okay, and the written down value means, if let's say we assume 25% depreciation every year, so the written down value will be every year we charge 20 based on the reducing balance. So first year is 90,000 into 25%. First year we charge 22,000. The machine will be left with 67,000. Then we charge 25% of 67, 16,000. Okay, and so at the end of the year we will be able to charge 84,000. In this case, the value will never be zero because you will still have left something which you can charge. The only thing is, after a very long period of time, the depreciation will be negligible, maybe zero or $1 or $2 only. That's it. Okay, but it will never become zero. So this is how we charge depreciation. Three different policies. Now you can say three different results, means three different accounting profits. Okay, so you have to choose your accounting policy based on how you feel the assets are used. If you feel the assets are used equally over the years, follow straight line. Straight line is the most simple method which you can use because you just have to divide by a number and then use it, right?
Most companies here.
Most companies use straight line, and even the government prescribes straight line because governments prescribe straight line. That's why they use straight line. But you can use any method that you want. Now, most of the normally the companies use straight line because it's very simple to use.
When would you use written down methods?
Hmm?
When would you use written down methods?
Where would you use, when you see that the asset will be mostly used in the initial years, and after the initial years, the usefulness of the asset is very low. For example, like production machines. So production money, when you are riding, when you just bought the machine, it's most productive, it's very efficient, highly efficient, right? After that, the efficiency will start to slow down, and at some point of time, the efficiency will be very low, or you need to spend more money to invest, correct, to keep the efficiency up. So if your depreciation is high in those years, then you have a problem. You can use written down value to charge more into the profit and loss in the initial year to save tax. But if the government allows it, if government does not allow written down value, there is no incentive. Correct? The incentive of charging written down value is you are charging more expense in the initial years and less expense in the future years.
So if you're like a car dealership, would you go with the written down
Car dealer. But what is the car dealer's asset?
the cars?
Now.
So that's inventory.
Yeah, that's another important point that you made up. In the difference between inventory and asset, it depends on your use. If you are if you are buying a car for buying and selling only, then it becomes your inventory, not your asset.
So if you're rental, you will use written down method, right?
Yes, because the cars will be highly producible in the initial years. First 2 3 years, the most productive. After that, the production will go down because the efficiency is very low, right? So you will not be able to use the car much. So you use written down value.